Good afternoon, and thank you for joining us today. I'm Kylie Wright, a partner here at Ulton, and I specialise in retirement planning, superannuation and estate strategy, particularly where super intersects with family outcomes and long-term security. Joining me today is my colleague Jess Wilkinson, who many of you already know. Jess works closely with clients on super strategy, structuring and implementation, and brings a strong practical lens to how these rules actually play out in real life. We'll be presenting together today, so you'll hear from both of us as we move through the technical detail and some real-world examples. In Australia, we don't have an estate tax, but for many families, it can feel like we do. Superannuation is often one of the largest assets people accumulate over their lifetime, yet it's also one of the least understood when it comes to death. Today is about lifting the lid on superannuation estate tax. All of the information we present to you today is general in nature, and you should not act on the information without having advice pertinent to your own personal circumstances. If you have questions, please use the Q&A icon that's at the top of your screen, and we'll answer them at the end. To start with today, we'll set the foundation by explaining what a superannuation death benefit actually is, how it can be paid, who it can be paid to, and why super doesn't automatically form part of your estate. From there, we'll step into the tax side of the equation, where tax applies, when it doesn't, and why adult children are often caught out by these rules. We'll also explain the difference between tax dependents and non-tax dependents and how taxable and tax-free components work in practice. Then we're going to bring it all to life with some real-life case studies showing how different structures, nominations and timing decisions can lead to very different outcomes. Sometimes it can be hundreds of dollars apart, even with the same family and the same assets. And finally, we'll talk about the broader considerations, not just for tax, but control, flexibility, estate risk, and making sure decisions made for the next generation don't unintentionally compromise your own security and well-being. So without further ado, I'll now hand over to Jess.
Kylie, and hi everyone, thanks for joining us. So a super death benefit is the amount paid from a person's superannuation when they pass away. It can include their accumulation balance, insurance claims for policies that are held within superannuation funds, and superannuation pension balances. By law, a super death benefit can only be paid to a Superannuation Industry Supervision or SIS Act dependent, which is a dependent as defined under super legislation, or the member's legal personal representative, and that's dealt with under the will. Importantly, super is not treated the same as other assets on death, and super is not automatically dealt with via your will. The way that your super death benefit is paid depends on three things. First, the trustee of your super fund. Every super fund has one. It's the set of rules that the trustee must follow. The second is superannuation law, which determines who is legally allowed to receive your super and in what form it can be paid. And third is whether you've made a valid direction, such as a nomination, telling your fund what you want to have happen. So the three main ways and how you can direct your super death benefit is the first, a reversionary pension. This applies if you've already commenced a pension. A reversionary pension allows the income stream to automatically continue to a nominated dependent, usually a spouse, when you pass away. The second option, it's a binding death benefit nomination. A binding nomination gives you certainty. If it's valid, the trustee must pay your super to the nominated beneficiary in the proportions that you've specified. The third option is a non-binding nomination. This one records your preference, but it's not legally binding on your super fund. They're going to consider it, but the super fund still retains the discretion. And this is an important point because many people assume that making any nomination guarantees the outcome, and that's certainly not the case. Where a member hasn't made a nomination, the super fund's trustee sets out the rules for who receives the death benefit. And at that point, the decision isn't yours, it's then the super fund trustees. Some trustees will exercise discretion, and that usually involves investigating potential beneficiaries, like requesting information from family members, reviewing relationships, and assessing any financial dependence or interdependency. Other funds take a different approach, as their trustee might have an automatic provision that requires the benefit to specifically be paid to either the legal personal representative or to a specific super law dependent, such as a spouse. And I guess the key point that I'm trying to make is that there's no standard outcome across the system if you do not have a binding death benefit nomination. Industry super funds, retail super funds, self-managed super funds, and public sector funds can and often do have different default outcomes. So not having a direction or particularly a binding nomination or a reversionary beneficiary, it's going to pose extra risks like having competing claims between your spouses and your kids, and your estate is more common. The disputes between them may escalate to the internal dispute resolution of your super fund or even onto the Australian Financial Complaints Authority, otherwise known as AFCA. Adult children may receive benefits over other intended beneficiaries, and the outcome can significantly differ from what the member actually intended. So that I can explain how this tax actually works, I'll just start by clarifying who is actually allowed to receive a super death benefit. And to do that, I'll talk about the two different definitions of dependents. So the first is the SIS or superannuation dependent. This determines who can receive the benefit, and the second is tax dependent, and that determines how the benefit is taxed. A SIS dependent generally includes a spouse, a child of the member, even where they're over the age of 18, someone who is financially dependent, which in certain limited circumstances can include adult children, or someone in an interdependency relationship. So that SIS dependent is what allows the super fund to pay the death benefit to that person. Separately, the tax definition determines whether tax will be incurred. So an adult child can receive a super death benefit because they qualify under super law, so the super fund can pay the amount to the adult child, but for tax purposes, they're treated as a non-dependent, which means that tax may apply to what they receive. And this is going to be a lot of what we'll be speaking around today. But before we go too much further, we just want to touch on interdependency relationships, because this is an area that is often misunderstood, and Kylie's going to run us through a little bit more with that.
Thanks, Jess. So this is the point where we just need to slow down for a minute, because interdependency relationships are widely misunderstood, particularly when it comes to adult children. So a parent-adult-child relationship is not automatically an interdependency relationship under superannuation law. While the law doesn't exclude parent-child relationships outright, the reality is that they will only qualify in very limited circumstances. For an interdependency relationship to exist, the relationship must go well beyond what we'd consider a normal family arrangement. The support provided needs to be substantial, ongoing, and intended to be permanent, not temporary or a matter of convenience. So this could commonly arise where there is a disability, a chronic illness, frailty, or advanced age, creating a genuine and mutual reliance. In those situations, the care and support is extraordinary. Personal care, domestic support, emotional and financial dependence, and there's a clear commitment to a shared life. By contrast, a friend, a flatmate, or an adult child simply living at home, they all come back, does not meet the threshold on its own. The law looks at the full circumstance of the relationship, including how long it's lasted, the degree of emotional support, whether property is shared, and whether or not the arrangement was intended to be permanent. The key takeaway here is that interdependency is not about labels, it's about evidence. And when these situations aren't clear cut, it's often trustees or the Australian Financial Complaints Authority, or AFCA, who end up deciding where your super goes. And that's why clarity and structure matter, because no one understands your family better than you do. To make this real, it's helpful to look at how these rules are actually applied, and this is where AFCA decisions become relevant. So these are two actual cases that went through AFCA. In the first example, we've got a mother and her terminally ill adult son, Joseph. Joseph couldn't live independently, and over several years, his mother provided escalating personal care, emotional support, and financial assistance. In that situation, AFCA accepted that the relationship went well beyond a normal parent-child relationship, and it did qualify as an interdependency relationship at the time of death. The second example involves former partners, and this case might be surprising. Although the spousal relationship had ended, Tim and Ryan resumed living together when Ryan became seriously ill. Sorry, Jess, can you just click forward for me? Tim provided extensive care and support to Ryan, and the arrangement was intended to last for the remainder of Tim's life. Again, AFCA accepted this as an interdependency relationship. So while these examples show is that interdependency is not about legal labels or past relationships, it's about the nature, depth, and permanence of care and support at the time of the person's death. And this brings with it a key risk. When circumstances aren't clearly documented or structured, it's not your advisor or your family making the decision on whether or not someone is in an interdependent relationship. It's the super fund trustee or AFCA. And while AFCA does a good job, no one understands your family, your intentions, or your dynamics better than you do. And that's why clarity up front through nomination, structure, and advice is really important. I'm going to hand back to Jess now to step us through how this feeds into the tax outcomes on a death benefit.
Thanks, Kylie. So we've spoken about what a super death benefit is and how it can be paid. Now let's turn to how the tax actually works. The first point I want to express is that there's no single tax outcome. To calculate the tax results, it really depends on three things. So how the benefit is paid, to whom it's paid, and the makeup of the super account itself. So if a death benefit is paid as an income stream, the tax outcome depends on age. So if either the deceased or the beneficiary is age 60 or over, the income stream payments are tax-free. However, if both are under 60, tax can apply to the payments. It's also important to note that non-dependents, like typically adult children, cannot receive the death benefit as an income stream. And because of that, we're not going to spend a lot of time on that today. If a death benefit is paid as a lump sum, the tax outcome depends on whether the beneficiary is a tax dependent, just like we discussed earlier. So tax dependents receive lump sum super death benefits tax-free. So spouses receive death benefits tax-free, as do children under the age of 18. Non-tax dependents, like adult children, don't pay tax on the tax-free component of a superannuation balance, but they do pay tax on the taxable component of a superannuation balance. And the tax that they pay on the taxable component is 15% plus Medicare levy, so that gives us a total of 17%. So at this point, I've introduced two important concepts, which are the components of superannuation, a tax-free component and a taxable component. Every super account is going to be made up of a mix of these components, and the split between them is different for everyone, which means that there's no single tax outcome, which is how I started this slide. So every super account is made up of these components, and the mix, it's generally determined by how you contributed the funds into your superannuation during your lifetime. So within the taxable component, we will have things like employer contributions and salary sacrifice contributions. We'll have personal deductible contributions, catch-up contributions if you've made any, and will also have superannuation earnings while you're in accumulation phase. Most people tend to have a higher taxable component, as these contributions are the ones that someone has claimed a tax deduction for. So more often we'll see larger taxable components in superannuation. In the tax-free component, this is the component that tax isn't paid on a death benefit. These are from contributions where we don't claim a tax deduction. So they might be spouse contributions, they could be downsizer contributions, or your standard non-concessional contributions, or even co-contributions from the government for lower income earners. Now, this slide and in our presentation today, we're really covering off taxable and tax-free components, but I did also just want to point out that in rare circumstances, there can also be something called an untaxed element within superannuation. Now, these are typically found in public sector and constitutionally protected super funds. And there's only a very small segment of these in the overall superannuation system, and that's why we are not going to be addressing that further today. So what I thought we'd do now is bring this together and look at how it actually works in practice. And I thought the best way to do this would be with a real world example. So this case study is about Greg and Loretta. Greg and Loretta are both 70 years old. Greg has an adult son, Brian, from a prior relationship, and Greg and Loretta together have one adult daughter, Anita. Greg and Loretta also have other joint assets that are outside of their superannuation. So in the event that Greg passed away, Loretta would become the owner of those joint assets. And because of that, Greg is comfortable that Loretta is going to be financially secure. So his main question is around how to deal with his superannuation, as he understands that tax may apply if he nominates his children to receive his superannuation, because both of his children are adult and they are financially independent. So Greg's superannuation balance is 1.66 million. The makeup of Greg's super reflects his lifetime of contributions, and the majority of these came from employer contributions over his working life, which means that his super, of course, is largely taxable component. Just by comparison, if we were to look at Loretta's superannuation, you can see that that is different, and that's because a significant portion of her balance came from after-tax contributions, and that's because Loretta did receive an inheritance, and she decided to contribute some of that inheritance into her superannuation and didn't claim a tax deduction for that. So that was a non-concessional contribution and formed part of her tax-free component. So Greg wants to understand the super death benefits tax implications before finalising his broader estate plan. Let's look at the first option available to Greg. So under this option, Greg directs his superannuation to Loretta, his spouse. He can do that by making a binding death benefit nomination, which we spoke of before, or if he was already in pension phase, he could also set this account up to be a reversionary pension to Loretta. But in our example, Greg has made a binding nomination to Loretta, who chooses to take that death benefit as a pension. So because Loretta is a tax dependent, there is no tax payable on the taxable or the tax-free component. This means that Loretta can receive the income stream tax-free. It means that she can make additional withdrawals from the account if and when needed, and these withdrawals will also be tax-free. Loretta still holds her existing superannuation fund as well. So taking this superannuation death benefit or giving it to the spouse and then having them take that as a death benefit is often an attractive option because it does preserve the tax effective environment of the funds that you have in super, and it provides ongoing income flexibility for Loretta. There is an important note that I've just put up on screen. There are some limits to how much one person can have in pension phase, but that's sort of beyond the scope of what we're going to be talking about today. So that option looks really good for Loretta, but Greg hasn't taken into account what to do for his adult children in this scenario. So let's look at an alternative option. Greg could nominate his children as the beneficiaries of his superannuation. So he could use a binding death benefit nomination to provide his benefit to Brian and Anita. Just remember they're adults, so they're not tax dependents for superannuation purposes, for tax purposes. Adult children cannot receive a death benefit pension. So in this case, the superannuation does need to be paid out to his adult children as a lump sum. In this example, the taxable component is 1.51 million, and the tax, if paid to his adult children at 17%, would be approximately $256,000 in tax. So that tax would be withheld by the super fund before the money was paid to his children. So while Greg's intention is for his super in this option to pay his children, there is a material portion that's lost in tax before they receive anything. So this option is still commonly chosen for a range of reasons, but it's important to understand the after-tax outcome, not just the headline superannuation balance. Taking advantage of the tax effectiveness of super as an investment while optimizing estate planning outcomes and avoiding surprises can certainly be difficult. Given that the tax management is usually the driving factor when it comes to deathbed withdrawals, it is worth considering the super landscape and the opportunities to improve some of these death benefit outcomes earlier in a client's life. And we'll take you through that today. If we look at another option for Greg might consider withdrawing his superannuation during his lifetime. Because Greg is over 60 years of age, he can withdraw his superannuation tax-free. So let's say Greg makes that withdrawal and he puts the money into a bank account, and then he passes away, and those funds are distributed via his will, and he nominates Brian and Anita to receive the proceeds from this bank account. His adult children aren't going to pay that superannuation death benefits tax, and the full amount could essentially be paid to them tax-free. Of course, Greg does need to make sure that his will says that this is particularly going to be provided for Brian and Anita. And that all sounds good for Brian and Anita, but let's think about what else there is to consider. So at this point, it's helpful to step back and look at the broader implications of withdrawing from super. When money sits inside superannuation, investment earnings are generally going to be taxed between 0 and 15%. Once funds are withdrawn and held personally, any income or earnings are then taxed at personal marginal rates, which can be up to 47%. Otherwise, once funds are withdrawn from super, you could loan those funds into a company where the tax rate would be 30%, or you could loan into a trust, which generally distributes the taxable income back to either a company or an individual. So again, the tax may be limited to about 30%. And as I mentioned before, in super right now, the general tax rate is between 0 and 15%, depending on whether you're in accumulation or pension phase. So in Greg and Loretta's case, they don't have a company or a trust. As I mentioned earlier, they do have some joint assets. So they receive rental income of around $43,000 per year. They both receive the Seniors and Pensioners Tax Offset, or SAPTO, so they don't currently pay any personal income tax. If Greg was to withdraw his super and he held that 1.66 million in a high interest bank account, let's just say it earned 4.15%, this is going to generate an additional income for Greg of around $68,000 per year. So that's going to increase Greg's personal taxable income, and let's say that his personal taxable income is then around $90,000 per year. As a result, Greg's personal tax position is going to change materially. Instead of paying no personal tax, Greg would then be paying approximately $19,000 per year in income tax. So while withdrawing from super may save estate tax for the children, and remember that figure was $256,700, it creates an ongoing annual tax cost for Greg of $19,700. And I guess this highlights an important point that estate tax savings are often one-off, but personal income tax costs can be recurring and compounding. And after 13 years, Greg would have paid more personal income tax than his children would have saved in estate tax. And I guess that doesn't mean that this strategy is wrong, but it does mean the decision shouldn't be made in isolation. So before making a decision like this, there are some questions that we always work through, and Kylie's going to start taking us through that now.
Thanks, Jess. So when clients ask, should I pull money out of super to save estate tax? Again, we do have to slow the conversation right down, because the true question isn't about the kids and then them saving estate tax. It's about you. So what are the costs to you for the rest of your retirement life? And by pulling the money out, how does this change your position? In that last case study, Jess showed a fairly substantial difference in the personal income tax. We also need to understand what is the cost of aged care today and in 10 or 20 years' time. While you may not be in aged care yet, it might happen at some point in the future. The honest answer is we don't know what the future holds. So we absolutely do a cost-benefit analysis in every case, trying to take in some of those outcomes.
So, and I think that cost-benefit analysis that we undertake, it has a range of components. Sometimes we're thinking about what the disposal costs of assets within superannuation might be. So, for example, if you have a self-managed superannuation fund, you have a property in that self-managed superannuation fund, there might be capital gains tax to sell that property. You might have real estate fees to sell the property as well. So that's a disposal cost that we want to be taking into account. Then we also want to be thinking about how does the withdrawal from super change your overall investment strategy. So if you decide to withdraw from a superannuation fund, are you going to keep that balance in cash in a bank account just like Greg did? Or will you be talking to your stockbroker about setting up a portfolio of Australian shares? And in the future, that portfolio of Australian shares in your own name might have capital gains tax consequences in the future. Withdrawing assets from super also changes how that super is dealt with in the event that you pass away. So we talked about that super is dealt with under a binding death benefit nomination. And whereas if you pull funds out and have that in a bank account, that's going to be dealt with under your will, and there may be an increase in estate challenges due to that. And Kylie just mentioned before about future aged care and health requirements. And I guess good advice isn't just about minimising the tax on death. It's about making sure that the strategy still works for you for as long as you need it to. And that's why we want to approach this as a whole of situation decision, not just a tax decision in isolation. And I guess tax is important, but it's rarely the whole answer. And Kylie's going to take us through a few extra case studies now to illustrate some of those issues that we've just talked about.
Thanks, Jess. I thought I would introduce Gwen first because her situation is incredibly common. So Gwen is age 65 and her primary objective is simple. She wants her wealth to ultimately pass to her adult son, Jeremy. So Gwen has done some things really well. She has a binding death benefit nomination in place on both of her superannuation accounts, number 1 and number 2, directing the benefits to Jeremy. So control and certainty of where the funds are going to end up are there. The issue is tax. So Gwen has around 1.36 million in her combined superannuation spread across the 2 accounts. The problem is that over $1 million of that balance sits in the taxable component. If Gwen passed away last week and her super was paid to Jeremy as a lump sum, he would face an estimated $175,000 in tax on that taxable component. And this is purely because he's an adult child and therefore a non-tax dependent under superannuation law. Gwen doesn't have a spouse or other tax dependents to leave her super to, but she is still eligible to contribute to super, and that creates an opportunity for us for some planning. Because Gwen was under 75 and her total super balance is below the relevant thresholds, we can consider a recontribution strategy. Earlier in the year, Gwen received a small inheritance and had already contributed $60,000 into super. This means she still has room to contribute $300,000 as a non-concessional contribution. So the strategy works like this. Gwen withdraws $300,000 from super account number 1, which has the higher taxable component, and then contributes the $300,000 into a new account, number 3, as a non-concessional contribution. Now, it's really important to note that when we make a withdrawal, the withdrawals are made proportionately from the taxable and tax-free components. So we deliberately withdraw from the account with the highest taxable component, account number 1, which means a large portion of what we take out is taxable and what goes back in is tax-free. So this isn't about changing how much Gwen has in super, it's about changing the composition of her super. So the outcome of that is, after implementing the recontribution strategy, Gwen now has a new super account, account number 3, which is entirely tax-free, and her remaining accounts have a significantly reduced taxable component in dollar value. If her super now is eventually paid to Jeremy, the estimated tax saving is around $44,700, without Gwen giving up control of her money, without gifting assets, and without exposing herself to additional personal tax. Importantly, in Gwen's case, this isn't necessarily a one-off opportunity. Subject to contribution rules at the time, Gwen may be able to repeat this strategy again in 3 years' time to further reduce estate tax. And this one is a great example of how estate tax planning doesn't have to be dramatic or risky, and it's not all or nothing. Sometimes it's simply about understanding how super is taxed on death and making small, well-timed structural decisions that significantly improve outcomes for the next generation. The next example I wanted to show you is a really good reminder that superannuation estate issues aren't just a later life problem. Let me introduce you to Wanda. Wanda is 25, single, living independently, and like many people her age, she hasn't really thought about estate planning. She doesn't have a will because she doesn't think she has much to leave. Tragically, Wanda passed away. What surprises most people is that Wanda's super suddenly becomes very significant. She only had around $10,000 in super, but she also had $200,000 of life insurance held inside the super account. So we're now dealing with $210,000. Remember, Wanda doesn't have a will, so who gets her super? The immediate assumption is that this would simply be paid to her parents because she's single, but under super law, that's not how it works. As Jess said earlier, because Wanda has no cis dependents, the super fund cannot automatically pay the benefit to her parents. Instead, her parents are required to apply for letters of administration, and only then can the super fund consider paying the benefit to Wanda's estate. Even once that happens, tax still applies. Her parents, via the estate, would pay around $35,700 in tax on the lump sum death benefit on money Wanda probably never even thought of as part of her estate. And this case highlights two really important points. First, super and insurance inside super operates under a completely different set of rules to your will. And second, a lack of planning doesn't just create delays, it creates cost, complexity, and stress and heartache for the people left behind. And this is why conversations around nominations and structure matter at every stage of life, not just when balances are larger or retirement is close. This case study is a reminder to ask your adult children if they're organised. Wanda's story shows us what happens when there's no planning at all, delay, tax, and stress for the family left behind. But the next case study is just as important because it shows the other end of the spectrum. And this is what happens when someone has planned, but where tax efficiency, estate risk, and personal security start pulling you in different directions. So our case study this time is about Jean, who is a 95-year-old widow, and the vast majority of her wealth, around $3 million, sits inside superannuation. Jean has a binding death benefit nomination in place to her son Ted, and she's been very clear in her estate planning that she doesn't wish to provide for her estranged daughter Emily. From a control perspective, Jean's done everything right. Her super's dealt with outside of her will via the binding death benefit nomination, which provides a strong layer of protection against estate challenges. The issue again is tax. Jean's super balance has a large taxable component of around 2.4 million, meaning that if her super is paid to Ted on her death, the estate tax is going to cost around 408,000. So naturally the question has come up, should Jean withdraw her super now to save that 408,000 in estate tax? If Jean withdraws the whole super now and puts it into her own name, she can absolutely eliminate that 408,000 estate tax bill for Ted, but there are consequences. The first thing is Jean would start paying around 30,600 per year in personal income tax on the earnings of that money that's now sitting out in her name. She's currently avoiding paying that personal income tax by keeping her money inside super. And it's not just paying the tax, it's also the fact that she's got to start doing tax returns again and pay accounting costs. Alternatively, she could retain the money in super. That's minimising her personal tax and protecting the funds from the estate and any challenges. Ted ultimately will pay estate tax. Now, I do note that this tax is a very unfair tax. If you know when you're going to die, you can pull your funds out the day before and avoid the tax. In this case, retaining the funds in super and passing them to Ted via a binding death benefit nomination probably gives the most certain estate outcome. Once the funds are withdrawn, as I said, they become estate assets if they're in Jean's name. And that means they're governed by her will, not by superannuation law, and Jean's will can be challenged by Emily, her estranged daughter. That structural change increases the risk of an estate challenge, particularly given Emily. If Jean left the money inside super, we've got higher tax, but the control and protection are stronger. And that's the point where we're often having to say to clients, this decision is not purely a tax decision. It's about balancing the tax efficiency against certainty, protection, and peace of mind. Now, a third option sometimes raised is Jean could withdraw the super tax-free, but then gift the money to Ted now. And on the surface, that looks attractive. The estate tax is eliminated and the funds sit outside the estate, reducing the risk of a will challenge. But in Jean's case, this option raises serious concerns. Obviously, once the money is gifted, Jean no longer controls it. She must rely on having sufficient remaining assets to fund her own care, her own health needs and quality of life at an age when costs can be unpredictable and significant. The gift is also counted under Social Security gifting rules for 5 years and remains accessible for both Social Security and aged care means testing. So it doesn't actually improve her position from a cost of aged care perspective. In practice, this option is very unlikely to be in Jean's best interests. And this brings us to the broader point. Good advice must balance tax efficiency with dignity, independence and flexibility because the person who built the wealth still needs to live on it. So these 3 case studies show us just how powerful and unforgiving super rules can be. Wanda's case showed us what happens when there's absolutely no planning. You've got delay, tax and stress for the people left behind. Gwen's case shows the power of small proactive decisions, same family, same money, but far less loss to tax. And Jean's case reminded us that the best tax outcome isn't always the right outcome because control, protection and personal security matter just as much. So the takeaway is really simple. Superannuation doesn't treat everyone the same, but the structure does. Good planning isn't about what happens when you're gone. It's about making sure the choices you make today will still protect you while you're here. And that's why I think the conversation today really matters. Now, I just want to go back a step because we're running a little ahead of time. And in Jean's case, Jean's our 90-year-old widow and we were considering pulling money out and gifting it to Ted. Just on that slide, Jess. The other thing I wanted to raise is if Jean, everything about this case is the same, but Jean now has been diagnosed with dementia and Ted is now acting as her enduring power of attorney, I guess the question becomes, how can Ted possibly make the right decision when he is very conflicted? It's very hard for Ted to take his, future beneficiary hat off and make the right decision for Jean in this circumstance. And this is why talking about all of these things early, way before we get to that point, are in everyone's best interests. Jess, I think we might have some questions and answers.
Yep. Just check the chat. First question is, so at what point does withdrawing make sense? So at what point does withdrawing from superannuation make sense in light of this tax?
Really interesting question. If you could time it perfectly, you would withdraw your money out of superannuation the day before you're passing away if you only have adult children as your beneficiaries. Look, every client is different. I recently did a cost benefit analysis with a client who was in her 90s, and the cost benefit analysis was around 3 years. So that's anything under 5 is when you might consider withdrawing from super. However, in that case, the client decided to leave the money in superannuation because they chose to prioritise their own interests over the kids' interests. And this is where depends what hat you're wearing. Are you the parent with taxable super, or are you the adult child? So we can do the cost benefit analysis. It's still going to be a somewhat emotional decision at the end of the day.
This is a good one. How does withdrawing super affect the estate challenge risk?
Yeah, so if the superannuation is in the estate, so you've withdrawn the money out, put it in your own bank account or invested it into investments in your own name, it then forms part of your estate, which is covered by your will. And estates and wills can be challenged. So if the money had remained in superannuation and you had a valid binding death benefit nomination, that is very difficult to challenge, much harder probably to challenge that than to challenge an estate. So potentially you are increasing the risk of an estate challenge if the funds are in your own name.
I think we talk about this next question quite a lot because we do often have our clients that are helping their children or even their grandchildren with expenses. So can my adult child be financially dependent if I pay their bills?
Yeah, that's an interesting one, and it depends on to what extent. So I have got quite a lot of clients that pay their grandkids private school fees, which are in effect benefiting their kids because their kids aren't paying those fees. That by itself probably doesn't produce an interdependency relationship. However, if you had an example of a case where you're paying the adult child's rent and assisting them with decision making, then in that case, that might be more of an interdependent relationship. So it's going to depend on the very specific facts. It is something that if you're paying anything for your adult children, we like to document that while you're still around, and that can assist with those decisions afterwards.
Yeah, and I think the occasional or discretionary support, such as helping with bills, is not going to be what establishes that financial dependency, particularly for adult children. It needs to be some sort of substantial support, and you need to be able to prove that the children relied on that to maintain a normal standard of living.
Yeah.
Now, there has been a couple of things come up in the chat as well. Let me just double check those. Are we going to talk about defined benefit super?
Probably not today. If you do have a defined benefit super fund, I really encourage you to reach out to us. They're under a whole other set of rules, and we will need to talk about that separately.
Yeah, I did mention that there are some super funds that we didn't touch on today, and unfortunately defined benefits are one because there aren't too many in the system these days, but some of these same concepts that we've been talking about today do definitely apply to them. So as Kylie said, probably reach out. Then what about if I leave funds in super, do the kids receive my super fund after the 17% tax has been taken out, or do they receive it all and then get a tax bill?
Yeah, really good question. So there's two different ways that adult children can receive super. It might be direct from the super fund, or it's gone via your will. So if it's gone directly from the super fund out to the adult child, the super fund withholds the 17% tax and they receive the net amount. So the tax will already have been taken when they receive it. Similarly, if the superannuation is going via the will, the super fund will pay the gross amount to the estate. The estate then has to withhold the tax and pay the net amount after the 17% out to your adult children who are beneficiaries of the estate. So in either circumstance, the kids will generally receive the funds net of the tax. It's not going to be their burden. And, you know, on that point, I had a client meeting recently where they referred to the super estate tax as a grateful tax, as in your kids should be grateful they're getting anything. But they will receive it net of that tax.
We've got a double question one here, so I'll split them out. Is a child at university a permanent dependent at that time?
Not necessarily. So if the child is still living at home, and you are and maybe doesn't have a job, and so you're fully financially supporting them and potentially also paying their help debt as they go, possibly they could be considered to be an interdependent relationship. If the child is boarding at home, has a part-time job, it's a question mark, but if they're living away from home and you're just assisting, they're probably not in an interdependent relationship. Again, if that is the case, you should be documenting exactly what you're doing for your children.
I just want to clarify there that interdependency relationships and having an adult child who is financially dependent, there can be two separate trains of thought there. But I agree with Kylie on the child at university. Unfortunately, that by itself isn't going to mean that they are a dependent. So the second block of the question there is, if you have 3 accounts, as in the Gwen example, is that all in the one super fund?
Yeah, so really good question. Maybe, Jess, could you flick back to that example? It depends. So if this was in a self-managed super fund, then this slide here where there's the 3 accounts, sorry, if you go down 2 slides, I think, Jess, to the after. One more. Yep. So in this example, if we're in a self-managed super fund, the client might have those 3 accounts within the self-managed super fund. They would just be, you know, probably pension number 1, pension number 2, and then new account number 3. If they were outside of the self-managed environment, the only way to do it would be to have 3 separate accounts, which then does mean you're having 3 lots of admin fees on your retail or industry fund. Again, when we're doing cost benefit analysis, we do take into account the running, future running costs of whatever we're doing. It might still be worthwhile having the 3 accounts held separately, even though, you know, it's another set of statements that you will receive.
Mm-hmm. And I think some of the comments that you've just made there are going to be relevant for this next question, which is, we have recently received an inheritance. Would we be best to open another super account to put this amount in rather than our kids pay 17% on the whole lot?
Yes, possibly. And again, we can't give you advice today, but potentially we can. And I just want to go back a step and just say that the estate tax is really a last spouse problem. While there's 2 spouses alive, when the first spouse dies, their super can go completely tax-free to the other super, to the other spouse. I just want to remind you. So really, this is all becoming a problem when there's only one spouse left. However, you may, it's going to depend on how much other super you've got is part of the answer. Sometimes it makes it worthwhile to keep the account separate, and it also depends on things like how much you're drawing down in the future. In this example that we've got on screen at the moment, for example, we would definitely only draw the minimum pension off accounts number 2 and 3. And if we were going to take more than the minimum pension, we would draw it out of account number 1 so that we're pulling more out of the account that is the most highly taxable, I guess.
Should everyone consider the recontribution strategy every 3 years?
Yes, as long as you qualify. So to do the recontribution strategy, you've got to tick off a whole lot of boxes. So you've got to be eligible to make a withdrawal from super. So that's generally over age 60 and permanently retired, or over age 65. And then you've got to be eligible to contribute the money back into super. So if you are have more than $2 million in your own superannuation account, you won't be eligible to make non-concessional contributions at all. And then between about 1.7 and 2 million, you may not be able to do the whole 360,000. It may be a lesser amount. So you need to understand the rules around taking it out of super and the rules around putting it back in. In general, yes, we should be looking at this for everybody well before you need to.
Yeah, I'm just going to link that back to the prior question too, because when you're considering a recontribution strategy, I also would be thinking, am I prioritising reducing estate tax versus do I have other wealth that may be beneficial being in that super environment at the concessional tax rates that superannuation provides? So I think we also need to consider, is there any other benefit that we can get by adding new money into super rather than just recycling what is already there? But good question. All right, I've just had a few more things pop up in the chat as well. What about doing a hybrid strategy of gifting the majority of funds to your kids to estate tax, to save estate tax, and then leaving just enough in your super to live on?
Yeah, I think that's certainly something that you consider, as long as you're going to get exactly right how much you need to live on, because it's highly unlikely if you run short in your lifetime that your kids are going to want to give you the money back. Once they've got it, they've got it. It also raises a whole lot of other issues, which I won't get into too much now, but the other issue, if you gift funds to children and they subsequently have a marriage breakdown, potentially half of your gift is going to exit stage left with your child's ex-partner. So there's a whole lot of information that we have to take into account before we would say to somebody, definitely you should be gifting to kids. It's big picture that we need to think about.
Yep, there was another question there that was about the child at uni being a dependent, so we did cover off on that in another question. How do they calculate the total super balance if you have a pension, judicial pension and SMSF?
Judicial pension.
Oh, yeah.
Judicial pension and an SMSF. Do you want to answer that one, Jess, or will I have a crack?
You can have a crack. It's been a while since we've looked at that, actually.
Yeah, so there will be this area in relation to judicial pensions is slightly in a state of flux due to the Division 296 tax rules that are coming in. However, in general, there's a formula used to work out what is the value of your judicial pension for the purposes of total super balances, and then that amount, whatever is under the formula, is then added to the actual value of your self-managed super fund. So it'll be a two-step process to work out what that is.
Look, and that one will also have implications on the contributions that can be made into super as well, because where you go over your concessional cap limit, that eats into your non-concessional cap limit, and that will that will impact the strategies that we've talked about here today too. We're having some really good activity on the questions, so there are a few more. What's the benefit to making the beneficiaries the legal personal representative?
I'm not sure whether there's a real benefit or not a benefit. I mean, the important thing to understand is that if super is going to adult children, it has to come out of superannuation. It can't stay in there and be passed in the background. Even if you've got a self-managed fund, it's physically got to come out of super. If your legal personal representative or your executors are the same people as your beneficiaries, then I guess they're going to be making the right decisions for themselves as beneficiaries. Where it can be tricky is if you've got say, 2 of your adult kids as the legal personal representative or executors, but you've got, 3 or 4 kids that are all the beneficiaries. So you need to think carefully about that. And we often think that having an independent executor can sometimes streamline that process and make logical decisions, not based on, who did what to who in the sandpit 25 years ago.
Yeah. Pete's asked a really good question. I like this question. I actually did my master's research project on this exact thing. So is there a dollar value point at which the benefits and the flexibility of a self-managed super fund, considering the estate matters, make it better than a retail fund or a defined benefit fund? So you can't really move into defined benefit funds. They're pretty limited these days. But comparing a self-managed super fund to a retail fund really depends on what you are trying to achieve in the self-managed super fund. Most of the time with self-managed super funds, you'll have particular assets that you can't access in retail funds. And retail funds have done a better job in more recent years of doing things like capping their fees and costs and widening their investment options. So it really is, am I doing something in a self-managed super fund that I can't otherwise be doing in a retail fund? And then doing a cost comparison of what it costs to have that self-managed super fund operational compared to the retail fund.
Yeah, and I guess one important clarification I'll just make there too is that all self-managed super funds have trust deeds, and you're going to live or die by how good your trust deed is. The trust deeds that we use say that you can have a non-lapsing binding nomination. So I make my binding nomination today. It will never lapse unless I want to actually revoke it and do a new one. Now, most retail super funds and almost all industry super funds have lapsing binding nominations, which means they expire every 3 years. If you have lost capacity at the time when your binding nomination has lapsed, it then might be very difficult or impossible to have it renewed if you don't have capacity. And that's where some very specific clauses in your enduring power of attorney come in handy for that purpose. Lots to think about.
Okay, I think we might be at the end of the questions now.
Yeah.
So one last point to touch on.
Yeah, so I wanted to end on a bit of humour. This is a recent cartoon that one of my clients gave me from February this year out of the Australian in relation to the Division 296 tax, where we've got the retired couple saying, but we worked hard and saved for our retirement, and Jim Chalmers saying, don't blame me for your poor life choices. So I couldn't help myself. I had to include that. I love it. We are doing a update on the Division 296 tax that has actually passed now. It's just waiting for Governor General to rubber stamp it, but the legislation is passed. So we'll be on the 15th of April, it's a Wednesday, we'll be talking about how that new tax will apply to super balances over $3 million. How earnings will be calculated, what the capital gains tax relief means, and what it will mean for self-managed super fund members. What sort of questions do you need to start asking yourself? There will be some key planning considerations both before 1st of July 26 and before 1st of July 27 that we have to think about. So everyone will get invited to that update. I will just make a note that while the legislation has passed, we don't have the regulations yet. We're hoping that they will quickly follow.
And that will be on at 12 o'clock, 12 till 1 on the 15th of April, Minna. Okay.
All right. Thanks everybody for attending today. We hope you got some good information out of it. We will be sending the recording of the webinar out to you along with a copy of the slides, and please don't hesitate to give us a call or email if you need any further information. Thank you very much.
Thanks everyone.